Hi everybody, welcome back to another video. So today we will look into Fraser Logistics and Commercial Trust Q1 2023 and is one of the REITs that is uniquely consists of both logistic and commercial properties in overseas market. So this is one of the REITs that you can actually see the exact performance difference between logistic and commercial sectors. So in this video, we will follow up with their previous quarter results from the current business updates that we can get the information from, and to see what are the red flags that we have to take note of when it comes to investing in Fraser Logistics and Commercial Trust. So let us take a look at their key highlights. So as you can see from the key highlights, the good thing is that the tenancy renewal for 4.7% of their gross revenue has been renewed, with overall rental reversion coming at a higher rate of 2.8%, which actually meant that the new renewal rental rate is higher by 2.8%. However, later we will see if the breakdown is more accurate, because this is just an overall number and the breakdown is more important, as they might actually sometimes show inaccurate or false positive results. Their majority of their assets are in logistic and industrial trust at 68.3%, whereas for their offices and commercial buildings are in the remaining respective percentage. However, as the management has mentioned before, they are looking to increase their L&I as they are the well-performing assets. And in the next quarter, I would expect it to increase because due to the upcoming 2 new projects that will be finished in construction. So, Fraser L&I is technically an overseas company because most of the properties are in the overseas, with Australia at 50.9% and Germany at 24.1%, which is the majority, whereas for Singapore only 9.8% is in Singapore. Because it's uniquely listed in Singapore, therefore all the distribution are in SGD. So Forex is very important for this REIT. So let us take a look into their debt profiles. As you can see, for the leverage ratio is still at a very healthy level of 27.9%, even though it went up by 0.5%. So these are the kind of levels which are good, as they provide opportunities to borrow extra debts to purchase assets at a discount when opportunity arises, should the management feel it's needed. However, it's also important for the REITs not to keep the leverage too low, because this will mean that the debt headroom is not being used to efficiently grow the REIT. So the REITs have to strike a balance between the two limits, and of course not hitting the limit of 50%. And as you can see, the management has actually stated that they have a debt headroom of 3,000 million to spend in any other potential acquisition that might come about. Okay, so likewise, for the cost of borrowing is still at a very healthy level of 1.7%, and is slightly increased by 0.1%, which is still very cheap as compared to the other REITs, with a ICR or interest coverage ratio, high interest coverage ratio of 13.6 times. So this value is very high partially because of the low cost of debt, and in the future or in the upcoming future, as they have to refinance, I expect this ICR to start dropping. However, their only renewal are only required in 2024 onwards, and if you are optimistic that by this period of time the interest rate would start coming down, then it's a good thing for these REITs, as they might be able to refinance at a lower interest rate than the current rates that the other REITs are getting. So for every REIT, interest rate definitely would impact on their distribution to shareholders. As you can see, although they have a fixed rate of 78.7% for their debts, they are actually still will get impacted by the increase in interest rate. So every 50% BPS increase will impact their DPU by 0.06 Singapore cents. So based on their recent half dividend of 3.77 cents, it equates to about a 1.59% drop in dividend. So one of the other unique things that will affect Fraser Logistics and Commercial income is, as for other REITs, similar to other REITs, is the strength in the Forex, because most of the properties are in Australia. Australia's currency strength is very important in ensuring that they maintain well in order to ensure that the income that they distribute to us in SGD is substantially in a reasonable level. Looking at the 1-year currency chart, Aussie dollar has dropped to the extent that now 1 Australian dollar can only exchange for 90 cents Singapore. So let me give you an example to see the impact. So as you can see, if the REIT is earning a revenue or income of 1 million Australian dollar, it will equate to about 0.9 million of SGD. So what does this mean? It means a currency loss of 0.1 million. However, usually REITs are earning way more as they are bigger. So as they get bigger, imagine if it's at 100 million Aussie dollar, it actually equates to about 90 million in SGD, and that means that there's a currency loss of 10 million. So all these are currency losses that you have to take note, as higher magnitude would result in lower income and lower distribution to shareholders. So this is one of the main factors of all overseas REITs are required to be taken note of. So because of all these currency strengths. Okay, of course, having a weaker currency also gives a good thing. As you can see that their debts are also hedged in different currencies in GBP, Aussie and Euro. So as all these currency strength drops against SGD, naturally they will slightly drop as well in the debts for the REIT. However, in my opinion, the incomes are more important as compared to the debts. So therefore, I would rather the currency to either stay stable or slightly stronger to a reasonable level. Okay, so let us take a look into their lease. So as you can see just now from the main slide, we have actually noticed that the lease portfolio rental reversion was at 2.8%, which is much better than the last quarter. However, if we look into their breakdown, is actually the REITs rental reversion is actually bumped up by some other commercial REITs, and as you can see from the Singapore one, it actually reversion came in at 16.3%, whereas the UK one came in at 9.9%. However, the Australia one actually came in at negative 4.1%, whereas for the L&I area, which is still doing well, came in at 2.3%. So all these breakdowns are important to look into and to see what is the annual increment. And for L&I, it's good that some of the properties are CPI linked, so this helps to hedge against inflation, whereas fixed increment is also good in the event if the inflation comes down, and REITs would still benefit by having a fixed increase in the increment of the rentals. Okay, so looking at the overall lease expiry profile, this is slightly good because they have actually mentioned that the renewal for the 2023 leases have actually come down from 10% to 4.7%, which is the results that last quarter I've actually mentioned about their lease expiring. So having a 4.7% left, which shouldn't be an issue for them to renew. However, their vacant actually slightly went up, partially due to the higher vacancy in the commercial sector. So their gross income from the top 10 tenants have also increased slightly to 25.4%, partially because of a new top tenant of Rio Tinto, which is a mining company, and the increase in one of the major tenants for Hermes Germany. So these two have actually contributed to a higher gross revenue for the top 10 tenants. However, this is quite a small increase, so it should be okay. So if you look into their breakdowns for the lease expiry profiles, Logistic is doing well, so that's not an issue. However, for commercial REIT, as you can see, the vacant has increased to 10.2% from 8% of last quarter. So it's important because one of the main concerns throughout the world is that because due to working from home or lower contribution or activity going back to office, this has caused commercial properties to decrease in demand. So this is one of the things that you have to take note of for commercial properties, and hopefully the management would be able to come up with ways to improve on the occupancy throughout this period of time. So it's also important for REITs to constantly have ongoing projects or acquisitions in order to ensure that their DPU can still grow throughout this period. As you can see from the ongoing projects, they have been on what the management has said, that this to focus on L&I developments, and they have 2 new properties that are upcoming, and I would expect them to be able to contribute immediately or close to the second half for the distribution, because they have already tenants leasing it or reserving it once it's completed at February of 2023. Moreover, there is another property that will be completed at December of 2023. So all these 3 properties would give quite a decent amount or contribute quite a bit to Fraser L&C. In conclusion, there are quite a few good things but also bad things to take note of when it comes to Fraser L&C. So let's get on with the good things first. The good thing is that their debts would only need to refinance in full year of 2024, which I feel that the interest rate would go down by then. Moreover, they also have a comfortable leverage and a good or a high interest coverage ratio, which would allow them to purchase more assets other than just the current 3 that are improving or upcoming building up. So this would give them a lot of opportunities to increase their distributable income to shareholders. Lastly, with their L&I doing strongly, they will be a good REIT to hold in the long term. So what are the things that, in my opinion, are the concerns for Fraser L&C? So the first thing is the occupancy of the office sector, where their occupancy hopefully improves in the upcoming quarter when the global economy gets better. Another 2 main risks is that the continuation decline in the Aussie dollar and the decrease in the occupancy will have a greater impact on their DPU in the long run. An additional pointer to take note is that their last distribution included a divestment gains, and if you removed it, the DPU would have only been 3.63 cents instead of 3.77 cents. So therefore, although REITs have been fundamentally good, it's important to take note of all these factors to buy the REITs at a reasonable price with attractive yield that you would find it good. If you like this video, please like, subscribe and comment on any concerns or what are your opinions with regards to Fraser Logistics and Commercial Trust. Moreover, you can also watch my other videos that I've done analysis on previously with regards to Capital Infrastructure Trust and the other dividend or REITs in the playlist. I also have a link for my Singapore Reits tracker in the description below that you can use, or you can see where I constantly update on the different important parameters that I feel that you should take note of. Thank you so much for watching, and I'll see you in the next video.